Hi, I'm Dean Meyer. In this short video, I hope to show you all the basics of bookkeeping, debits, credits, all that stuff. And bookkeeping is the foundation of all accounting. When you first start a company, there's nothing. It's like a blank piece of paper. So let's pretend that we want to start a used car company, and we have an investor who's willing to give us a little seed money to get going. Now we can think about this company in terms of what it has and what it owes. It has assets, those are things you own, and you owe two kinds of things. You owe money to other people, like a bank you borrowed from or a supplier who sold you stuff. But ultimately, all the profits belong to the shareholders. And if you were to close the firm, you would owe them whatever is in accumulated profits. That's called equity. So we have assets, things you own, liabilities, things you have to pay back, and equity, which you don't have to pay back unless you close the company. That's what the shareholders own of your company. Now, whenever you get something, you have to give something up of equal value. That's the notion of double entry accounting. For example, if the bank loans you money, you get an asset, cash, but now you have a liability, the debt. You've got to pay back the bank. Everything stays in balance. And we can keep track of what we have and what we owe with what are called T accounts. T is across the top. And this way, we can track separately things we put in and things we take out. For example, on the asset side, we'll have an account for cash, the bank account. When you put things in, that's something you get. It goes in on the left. When you write a check, that is take things out, we'll put that on the right. And what's left is the balance. When you borrow money from the bank, you get a debt. That goes on the right. When you pay it off, you note that on the left, and the balance goes to zero. Anything that is on the left, we'll call a debit. It's abbreviated DR. Anything on the right, a credit. Debits on the left, credits on the right. Generally speaking, debits are when you get something, and credits are when you give something up. Sometimes you want to track things going in and get a total separately from things going out. For example, with regard to your equipment, assets that you're going to keep for a long time, you might want a total of what you paid for all those assets, which is like the property you own. And separately, you might want to accumulate depreciation in another account. Of course, the net is the book value of the assets. It's what's left of the assets after depreciation. So you put the initial cost in one account on the left and the depreciation in another account on the right. That way, when you run reports, you can see the total separately and still get the sum of the two, the book value. When you have two accounts that are really the two halves of the T of one thing, that's called a contra account. Capital assets and accumulated depreciation, the contra account. Now, when you pay expenses, ultimately your shareholders have less. So you owe them less. So that goes on the left. That's something you get. It reduces what you owe to shareholders. When you get revenues belong to the shareholders. So you owe them more. So that's something you give up. That goes on the right. The net of that is profit or loss. And that profit or loss, that net, belongs to the shareholders. So it's what you owe them ultimately if you were to shut down the firm. There are lots of different types of accounts. Let's look through the assets, things you own first. Of course, you have cash, bank account. You have accounts receivable, things when your customer owes you and hasn't paid yet. You have inventory that you paid for. If you pay an expense in advance, that's an asset, because now you can consume the service and not have to put out any cash. You take it out of prepaids. So prepaid expenses, when you pay out, you now own a claim for service. That's an asset. Claim for service would be a good way to think about it. And we have long-term capital assets, things that last for years. This is where we might want a contra account. What you paid on the left, accumulated depreciation. In the contra account, the net is book value. Now we'll look at what's on the right side of the ledger, things you owe. You could break that into as many accounts as you want. For example, loans from the bank, accounts payable, which you owe to your suppliers, taxes payable, which you owe to the government. How about when people put money on deposit with you to buy something later? They put money down this month and then buy it next month. That's something you owe back to them, because if they cancel the deal, you got to give it back to them. So that's on the right. It's something you owe, and it's called prepaid revenues. Prepaid expenses are when you pay a vendor for a service in the future. Prepaid revenues are when your customers pay you for a service in the future. Now remember, the other type of thing you owe is to the shareholders, the equity. So owner's equity is here on the right. Remember, when you pay expenses, you don't owe the shareholders as much. So that's going to go on the left against owner equity. And when you receive revenues, you owe that to the shareholders. So that goes on the right, things you owe. We can keep those separate, like contra accounts, and end up with a profit or loss. A profit or loss, which we know belongs to the shareholders and is ultimately going to go up here into equity. You can have as many types of accounts as you want in any of those three categories: assets on the left, liabilities and equity on the right. You can break things into lots of detail. You could have different bank accounts, like a spending account, a checking account, and a money market, and so on. You can have investments, all kinds of accounts on either side of the ledger. Now, let's start our company. Remember, whenever you get something, you give something up. So our shareholder who's willing to invest in us gives us $50,000 of seed money. So what do we get? We get cash. That goes on the left. What do we give up? Well, the owners have now a claim on our company. They really own the company. So that's something that we owe them. Over here, you see we'll put $50,000 in cash, and scrolling down, $50,000 in equity, which belongs to the shareholders. Let's also borrow some money from the bank. They trust us, they give us $100,000. So we get cash, but now we have a loan we have to pay back. 100,000 debit, cash on the left, 100,000, credit, loans, 100,000 on the right. So we now have 150,000 in our bank account, 100,000 of which we owe to the bank and 50 to the shareholders. Now, you're going to pay interest on that loan. So let's say the bank at the end of the month sends you a bank statement, and it shows that they charged you $500 of interest. Well, that's an expense. So you don't have to pay it to the shareholders. They don't own it anymore. So that goes on the left. We debit expense, but we owe the bank the interest. So what we owe went up. Credit loans. $500 credit loans, we owe the bank for the interest as well as the initial principal. And that goes down here on the left, an expense that we don't owe out to our shareholders. Well, we better make a payment on that loan. So we're going to reduce the loan by the amount of the payment, but we got to write a check. We debit loans, $800. We credit cash. We just wrote a check out of cash and into a liability to pay down a debt. Everything balances. Now, this is a used car lot, so we got to buy some cars. That would be our inventory. So what we're going to get when we buy a car is inventory. What we got to give up is we got to pay for it. So we'll buy $50,000 of inventory and write a check for it. Now, we also need some desks to go into this little office that we rented on the car lot. So we go to the furniture store and we buy the desk, but the desks are going to last, 5 years, maybe more. So the Internal Revenue Service will allow us not to spread that expense, or actually requires us to spread that expense over the useful life of the asset. If the desk lasts 5 years, we can't write off the desk as an expense right now. We have to write it off over the course of 5 years. So that's what a capital asset is. A capital asset is something that has value over a period of time, and you depreciate it. You write it off gradually over those 5 years, or whatever the useful life may be. Okay, so let's buy the desk. They're going to give us $60 to pay. So we don't pay out cash yet. We will credit accounts payable, like a loan. And there's the capital asset, the $10,000 in desks and office equipment and so on. Now we have to pay for those desks. Remember, accounts payable, we owed it to them in 60 days. So we're going to get off the hook on what we owe them. That is a reduced debt. And we're going to write a check, reduce cash. So debit 10,000 to payables, write a check for 10,000. We're in balance. Now, being a capital asset, I said you have to depreciate it over time. So let's say we're depreciating at $200 a month. Well, that's an expense, a debit expense, and we're going to reduce the value of our assets. Debit expense 200, but depreciation in the contra account, which reduces the value of the capital assets, the book value of the capital assets by that amount. Finally, we sell a car. Yay! We paid $5,000 for it. We sold it for $6,000. Well, those are two things to take note of separately. First, we sold it for $6,000. So the customer owes us the $6,000 and they're going to pay us next month. And that is revenues that belong to the shareholders. So we credit revenues, ultimately have to pay it out to shareholders. Now we have that inventory. We're going to take it out of inventory, that is credit inventory, and put it into expense. If you look at this transaction, everything balances. Note that we've got revenues of $6,000, expenses of $5,000. That's $1,000 of profit which belong to the shareholders. But our assets went up by the same amount. We got a receivable of $6,000 and only gave up inventory of $5,000. So our assets went up by $1,000. It's in receivables for now. But we got to pay that out to shareholders. The net difference of those two things. Now, the end of the month comes and they pay us for the car. Well, that's simple. Customer got the cash and we no longer we gave up the receivable. There's the $6,000 they paid us in the bank and we no longer have a receivable. Well, we're going to have to pay income tax on that $1,000 to the tune of, say, $300 of tax, income tax, corporate income tax. So that means we have an expense of $300 and a payable to the government of $300. There's the payable, and down at the bottom, there's the expense. Everything is still in balance. Now, a customer says, look, I'm saving for a car, can't afford much. How about I give you $1,000 this month and maybe $1,000 for the next few months, and when I finally buy the car, I'll have already paid for it. Say, sure, I can do that. So they want to put $1,000 on deposit. We get $1,000 of their cash, but if they change their mind, we owe it back to them. So it's like a loan, a payable. They give us $1,000, and on the right, that's called prepaid revenues. It'll become revenues when they buy the car. But for now, it's like a loan. So it's over there on the right. Now we decide to subscribe to Zoom for some marketing reasons. Now, Zoom gives you a discount if you pay the whole year in advance. So we do that. I don't know what the price is, but let's pretend that we give them, write a check for $240 for the year. So cash goes down, and what we get is prepaid expense, a claim on their service, so that we don't have to pay any more for the service when we consume it. We wrote a check for $240, and we have prepaid expenses, a value to us over here on the left. Now, each month, we have to recognize the expense. So it's $20 a month. So that's an expense, and we don't owe back as much to Zoom. That is, we don't have as many claims on the service. So prepaid expenses go down. We used up 20 of the 240 of our claims in advance for the service and recognized it as an expense. That's when we actually consumed it. We consumed $20 worth of that stuff. Now let's say we want to set aside a little money for marketing. It could be we spend a whole lot on marketing one month and nothing on the next, and nothing on the next, and then a whole lot more. We want to even that out over time so that we can understand our run rate, our ongoing expenses more evenly. So what we want to do is put the same amount into what's called a reserve every month, and then we can spend out of that reserve. So let's look at the transaction. We're going to recognize every month $400 of marketing expense. Whether we actually bought that much or not, we're just going to average it out, smooth it out to $400 a month. And we're going to put that in a reserve. If we collapse the reserve, it would go the other way. So there's the marketing reserve. It's a liability. It's something we owe. We have to pay for actual marketing expenses, for advertising or whatever, in order to reduce that. And we've already expensed it. So we expensed $400 a month for marketing, whether we've used it yet or not. Now we have a marketing expense. We actually use some of that. So we've already expensed it. All we're doing is moving it from the reserve to cash. That is, we pay a check for $250 worth of advertising, and we pay it out of the reserves. So there's the check. And there's the reserve. The reserve went down by that amount. Of course, each month we'll put more back in, whether we spend it or not. So that's how you even out expenses over time. Hey, remember that customer that put $1,000 on deposit with us? Well, they see a car, it's only $2,000. They've got another $2,000, so they'd like to go ahead. So our prepaids, which they put on deposit, we no longer owe them. Plus, since we no longer owe them, that's a debit, something we get. And in other words, now that they're going ahead with the car, the prepaids become ours. And they give us another $1,000 in cash, which are revenues, $2,000 in revenues. But remember, we had to give them a car that we paid $1,500 for. That's still a profit. So we have to recognize the expense of $1,500 and reduce inventory by that amount. So we're debiting prepaid revenues. We no longer have those. We're debiting cash. That $2,000 is revenues, but we reduced inventory by $1,500. And that, of course, is an expense that just happened. Well, you're feeling good about your future, so you're ready to pay yourself a little compensation, a little salary. How about $3,000? Isn't that optimistic right now? $3,000 salary. But when the company pays you $3,000, they also have to pay the government for payroll taxes. So that amount is a payable to the government, $300 in payroll tax, which you owe the government. The employee also owes the government for some deductions, like you withhold their federal income tax, their state income tax, as well as their share of Medicare and FICA. So let's say that's $600. That's coming out of the $3,000 salary. And this is what's called the balancing entry. We add up this minus that, and what we have left is $2,400, and that's the check you'll actually get. That's your paycheck. So we had salary expense, plus the company owes payroll taxes. And that, you'll recall, is a payable right now. Payroll taxes. Here's the employee withholdings, which is a payable you owe the government. And the paycheck itself is $2,400, reduces cash. Your shareholder wants some money out of all this too, so you're going to have to pay a dividend someday. Let's say we pay a dividend of $1,000. So that's money we no longer owe the shareholders. That's coming out of equity. And we write a check for $1,000. So there's a dividend. It's no longer coming out of equity, no longer part of what we would ultimately owe the shareholders when we shut it down. And there's the check for $1,000. There you have it. Basic bookkeeping, debits and credits in a nutshell. Hope this was useful. Thanks for watching. If you want to contact me, look at ndma.com. Bye for now.